In this video, we'll be working on partnership financial statements. Now, partnerships have financial statements just like sole proprietors do. They have income statements, balance sheets, and also partners capital statements. So instead of an owner's equity statement, they have partners capital statements. It sounds different, but the process and the thinking behind that statement, the partners capital statement, is similar to what we did in accounting 1 when we did an owner's equity statement. So without further ado, let's look at an example that can help us to understand partnership financial statements a little bit better. So if you look at your handout, example 9 is actually a continuation of example 8. In example 8, we did all the income allocation for these two partners, Lee and May, and I'll refer us back to that in a minute. But let's just see what this question is asking us to do. Assume that Lee and May's capital balances at January 1st, 2014 are 28,000 and 40,000 respectively. So respectively just means that 28,000 belongs to Lee and 40,000 belongs to May. Lee and May made additional investments of 2,000 and 3,000 respectively during the year. So they increased their investment in the business, Lee by 2,000 and May by 3,000. Lee and May had drawings of 1,500 and 2,000 respectively. Prepare the partners' capital statements at December 31st, 2014. Note, the net income numbers were calculated in a previous exercise. That's correct. That was from exercise 8 or example 8. So where do we begin? Well, it's important to first remember what exactly is needed to show the partner's capital balance. So if you recall from accounting 1, we always have a beginning capital balance unless the company just started, at which point the capital balance would be 0. But since this company has not just started, the partners have a beginning capital balance. We also need to account for any additional investments by the partners. We also need to account for any net income or net loss. And finally, we subtract any drawings that the partners may have made. So what the partners capital statement will show is what the partners investment or stake in the business is at the end of the year, consisting of a beginning balance plus anything that they put in, plus any net income or minus net loss, and finally minus any drawings. So let's go in and try and see how we can do or do the answer for this question. So just to cast our minds back, in example 8, we had calculated the net income allocation for each of the partners. So we at least have that amount. But now we are moving on to example 9. We'll use the amounts from example 8, but let's focus on example 9. We are being asked to make a partner's capital statement. So we begin by putting the name of the company, and we also put the name of the financial statement that we are building. We also have to put the period of time, right? So since this is for the year ended December 31st, 2014, right? Again, thinking back, income statement, owner's equity or partner's capital statement are all for a period of time. It's just the balance sheet that is at a point in time. So now we begin to build this partner's capital statement. So we've got each of the partners we will show separately. So that's a little bit different from when we did it for a sole proprietor, right? It was only one person, whereas for these it is 2 or more people. So where do we start? Well, there should be a beginning balance. And based on the question, we were told that Lee's beginning balance was 28,000 and May's beginning balance was 40,000. We always keep a total on the side over there to just be able to show a user what the total capital is, because sometimes a bank, for instance, may want to see total partners capital, not just each individual partner's capital. So now we add the additional investment that each partner made. So that investment is 2,000 for Lee and 3,000 for May, giving us a total of 5,000. We also need to add any net income or net loss. Again, you may recall from the previous question that there was an income amount of 57,000. So that amount gets added in, but not just 50/50. Remember, we have already allocated partners' income. So what we do is we take Lee's 33,000 allocation and we include that, and then we also include May's 24,000 allocation of net income. Together they should make up the 57,000 net income. And finally, we subtract our drawings. And the drawings number is given in the question. For Lee, it was 1,500, and for May, it was 2,000, giving us a total drawings of 3,500. Remember, these amounts are being subtracted, so we might actually be better off putting them in as negatives so that we can remember that they are supposed to be negative subtractions. And then we know we need to calculate the capital balance at the end of the year, so we can go ahead and do that. So there's our double underline. And now, because we already have a negative year, we can just sum these numbers and drag this across. And so we have 61,500 is the balance for Lee's capital, 65,000 for May's capital, and 126,500 is the total of the partner's capital. We are not done yet because the question also asked us for that's the end of the question. Excuse me. I'm thinking about example 10 that asks us for an owner's equity section of the balance sheet. So this is the end of Lee May's partner's capital statement. So just to point out a few things, again, you show each partner individually and also a total. You always have a beginning balance, even if it's zero. Add any additional investments, which would be given in the question. Add the net income or subtract the net loss, which would be based on the income allocation, and then subtract any drawings to get to the ending capital balance. Let's move on to example 10. So this is Starlight Company. So for Starlight Company, beginning balances on January 1, 2014 are Gary Stark 20,000 and Jim Nyland 18,000. During the year, drawings were Stark 8,000 and Nyland 5,000. Net income was 30,000 and the partners share income equally. So prepare the partner's capital statement for the year and prepare the owner's equity section of the balance sheet at December 31, 2014. So we've already built a partner's capital statement from scratch in example 9. So over here, I'm just going to show you the answer. And then you can, of course, feel free to do the calculations on your own. We obviously put the name of the company, the name of the statement, the period of time that applies, and then we begin with the beginning capital balance. It's given in the question, right? Stark is 20,000, Nyland is 18,000 for a total of 38,000. We then add the net income. Net income was 30,000 and the partners share it equally, which means 15,000 per partner. And then there were drawings of 8,000 and 5,000 respectively. So in the end, Stark has a 27,000 partners capital balance, Nyland has a 28,000 partners capital balance, and the total is 55,000. That's the partners capital statement. Now moving on to B, it says prepare the owner's equity section of the balance sheet at December 31st. So now we're on to the balance sheet, right? We've moved away from partner's capital statement. So the balance sheet, Starlight Company, name of the company, name of the statement, and the balance sheet is at a point in time. So we just have December 31st, 2014 as the date. The owner's equity section of the balance sheet falls under a main heading called liabilities and owner's equity. The subheading is owner's equity, and here we put each partner. So Stark has a 27,000 balance, which comes into the balance sheet. Nyland has a 28,000 balance, which also comes into the balance sheet to give us the same total of 55,000. So in this video, you've been able to see how to build a partner's capital statement and also show the owner's equity section of the balance sheet. In the next and final video, we will look at liquidation of a partnership.